Everyone, we're just going to finish off the second half of the 2010 paper. Remember to make sure that you've tackled this paper in advance of watching this video. Okay, let's get going. Right, number 15. After a certain point, an increase in the average wage earned in an economy reduces the total quantity of labour hours supplied. What could explain this response? So, when it comes to this is really all about the backward bending supply curve of labour. If I just draw this out quickly, okay, then right, the fact that labour can often be considered to be an inferior good, that people don't really want to consume it, but as they consume more of it, they're likely to actually want more leisure time. Now up here as well, I've put down that the income effect becomes very, very strong up here. Now down here we can see that the substitution effect is likely to be highly positive, and the substitution effect will dominate here at lower income levels. So people will want to substitute leisure time for work time, because they're not spending much time in work at the moment and they're attracted by the higher wage rate. But up here you are attaining the level of income that you probably want to achieve, and then you actually start to value your leisure time far more. And further to that, you want to be able to spend some of your income effect. So the income effect dominates at these levels, whereas the substitution effect would dominate here. Okay, so let's see what we've got. So A, the substitution of other goods. Well, it's not other goods, it's work for leisure. So that's incorrect, because it says that an income effect outweighing a substitution effect. Well, that's clearly our answer here. So therefore the answer for 15 would be B. Number 16. What might explain why a country's GDP remains unchanged despite a rise in labour productivity? Okay, so we've got a rise in labour productivity, GDP unchanged, an increase in average hours worked. Well, if there's boosted productivity, GDP will be higher. An increase in the birth rate, well, that could affect GDP per capita, but not total GDP as suggested there. An increase in the retirement age, well, if people are retiring later and working longer, particularly under higher labour productivity, then that's going to boost GDP. So we know the answer is D. And an increase in the student population means, of course, that there will be an opportunity cost of going to university, and that is foregone earnings or foregone GDP for the economy. Right, number 17. Okay. What would be most likely to cause a decrease in aggregate demand? So remember that aggregate demand consists of C plus I plus G plus X minus M. So any of those factors that reduce those elements apart from M, increasing M would increase the withdrawals from the circular flow of income and reduce aggregate demand. So first point we've got here is the removal of import quotas. If you think about the nature of that, that's going to reduce the prices of imports. So therefore, yes, that would mean more imports are consumed and more money actually leaves the economy. Okay, so aggregate demand would decrease. The answer is A. An increase in the rate of unemployment would increase aggregate demand. Female participation would obviously increase aggregate demand. Removal of immigration controls would also boost aggregate demand. Okay, number 18. Assuming no real aggregate expenditure on goods and services, what could cause an increase in unemployment? Okay, so could it be a decrease in labour productivity? Right, a decrease in the population of working age, or an increase in the participation rate. So if we think about these, this first one would reduce the marginal revenue productivity of workers. So it may mean that they earn less. Okay, a decrease in the population of working age, well, that's going to increase employment overall, so it's not that one. An increase in the participation rate, well, this is plausible now. So if we just have a go at drawing this out, just to illustrate this, say for instance if a minimum wage is introduced, then we can impose that minimum wage at a higher level above the equilibrium. Here we've got our wage, we've got our level of employment, and we can therefore see, according to our demand and supply, that we now have E star, okay, which is our allocatively efficient level, E1, there's our new national minimum wage, okay, and that would have been our previous wage at W star there, okay. So based upon that, we can then see that, look, there's an increase in the participation rate from E star to E2, and that actually prompts an increase in unemployment in this circumstance between E1 and E2, okay. All right, so the participation rate seems to fit quite nicely there, okay. So the answer would be C. Number 19, the table shows the price indices and weights for 3 commodity groups that are included in the calculation of the country's cost of living. How much has the cost of living increased since the base year? So the base year would be, of course, 100, okay. So let's work this out. So we can see these indexes and the weights, okay. So an index, or a higher weighting, of course, means that the good is consumed more often, like for instance bread, as opposed to toothbrushes, which receive a lower weighting. Okay, so let's just work these figures through. So we've got to do 300 times 4, the actual weighting, that gives us 1200. 140 times 3, that would equal 420. Then we've got 80, 160, 240 for this one here. Okay, so this would be as a total 186. Okay, so that would be our total. Okay, right. So going from 186 from 100, we can see we've got an increase of 86 there, okay. So the overall increase is 86, the answer would be B. Okay, right, number 20, which combination of changes is most likely to result in an increase in a country's rate of inflation? So we can just see we've got exchange rates here, indirect taxes and money supply. Just looking at the exchange rate, you consider the depreciation in the pound following the Brexit referendum. That's of course increased import prices into the UK, so I'd immediately be drawn to answers A and B. So we've got a falling exchange rate. At the same time, indirect taxes, if VAT went up from 20 through to 22%, then that would add an extra 2% onto prices. So the answer is going to be B, yeah. And there we see the money supply rising, which would of course cause a reduction in the actual value of money. Okay, right, 21. Okay, so we've got 4 Lorenz curves in the diagram. Now, which country has the greatest degree of income inequality as measured by the Gini coefficient? So we've got our line of equality here, where we would have 0 on the Gini coefficient, and we've got our base period where we've got say 1 person owning everything in the economy, or 1% of households owning everything in the economy. So we're looking for the biggest gap between the line of equality, and we can see that C would fit that bill. So very simply, the answer would be C. Okay. 22. In a given year, a country attracts a net inflow of foreign investment, resulting in a surplus in the capital and financial accounts of the balance payments. What must simultaneously occur? Well, you've got to remember that we've got capital and financial accounts. The other side of the balance payments is, of course, the current account. Okay, so here, if we've got a surplus on the capital account, we are going to be looking at a deficit. So we can skim through, see if it's there. There it is. Yeah, answer C. Okay. 23. In an economy, the proportion of the working age population and employment increases from 70 to 80%. Okay, what is likely to be the effect on output per worker and on GDP per head? Well, we know from GDP per head, if we've got more employment, then that's obviously going to increase overall GDP per head rather than people just being active, economically inactive. So we're immediately drawn to A and C. Okay, what is likely? So now we've got to consider output per worker. So really now we've got to think about the nature of these employees. These employees are going to be, in all likelihood, less economically productive than the first 70% of people that already had jobs. So to that extent, then you would expect a decrease in output per worker because you're recruiting less skilled people in all likelihood here. An example of this, say for instance in France, the unemployment rate is very close to 10%. In the UK it's just over 4.5%, but our productivity is much lower. Okay, moving on to the next one then. So in a closed economy, households pay 25p in tax on every pound increase in their gross income and spend 4/5 of every increase in their disposable income. What is the value of the multiplier? Okay, so we've got some calculations to do here. So let's just move that up slightly there. So we can see that we have got 0.75 left after this withdrawal takes place on every pound increase in gross income. Okay, further to that, we can also see that the consumers would now spend 4/5 or 0.8 of this. So if we multiply 0.75 by 0.8, that will give us 0.6. That tells us what our marginal propensity to consume is. Okay, now the multiplier is calculated, of course, by 1/1 minus MPC. Okay, so let's just work through this, and we can see that we would then get 1 divided by 1 minus 0.6. Okay, that would of course translate to 1 divided by 0.4, and that would equal 2.5. Okay, right, so the answer would be B. Right, so 25. Table shows marginal utility derived by a consumer who devotes the whole of his weekly income of £32 to two goods X and Y, whose unit prices are £2 and £4 respectively. Okay, fine. So we can see that based on this, we've got £2 and we've got £4 here. So therefore, as a result of this, we can see that that is going to amount to £4. That's going to amount to £8. That one is going to amount to £12. That one's 16. Okay, and then just working through these, we can see that we'd end up with 28. Incidentally, we've got to remember, just going back to the question title, that they've got to spend £32, okay, because they are spending the whole of his weekly income. Okay, so we can see that is 32. Okay, let's just come back down here. So we've got 24, so that again equals 32. Then we've got C and D. C would be 16. Okay, so this only equals 28, and then we've got just 12, and again we've got 28. So we know it's either A or B, so we now need to narrow that down further. Okay, so firstly, when it comes to A, we can see the utility derived, and it says in order to maximize his utility. So we can see that we're dealing with 17 units of utility, and at 7, well, we can see based on that it's all of that utility that would be derived. So how much does that amount to? 42, 50, 60, 76, 90, 102, 112. Okay, so that amounts to 112. So therefore from there we can see that the total utility derived is 129. Okay, if we look at B, This time we're going up to here. So we can see we've got 17, 24, 30 utility derived from X, and then when it comes to 6 units, we're just going up to 6 units now, and so we can just take off 12 there, and we've got 100 exactly. So therefore we can see that we've got 130 against 129. Okay, so here we go, that's the answer, B. Okay, right, next one, 26. Curve GH in the diagram shows the different combinations of fiscal and monetary policy a country's central bank believes would enable the country to meet a given inflation target. Okay, so what could cause the curve to shift to JK? So principally here we're looking at an increase in the central bank base rate here. So anything that's creating inflationary pressures is likely to be our answer here. So what could cause the curve? A depreciation of the currency. Well, we know this creates weak pound, imports dear, exports cheap. Okay, so yeah, the answer looks really like it's going to be A. Let's just run through the others just to make sure. A new forecast predicting higher levels of unemployment. Well, it would go the other way then. It would go that way. An increase in the standard rate of income tax. Well, if you've got contractionary fiscal policy, you're likely to use expansionary monetary policy at the same time. An increase in the government's rate of inflation. Again, that means you tolerate higher levels of inflation, and that would allow you, with all three of these, to actually decrease the central bank base rate. Okay, 27. Diagram shows the amounts of wheat and clothing that can be produced in countries X and Y with a given quantity of resources. Okay, so we've got country X, which can produce an absolute advantage of wheat. Country Y, we've got an absolute advantage in terms of the production of clothing, and a comparative advantage. Okay, so what does the diagram indicate about the production of these two commodities? Both countries have an absolute advantage. No, both countries have a comparative advantage. Well, you can't have both countries, because remember Ricardo's model is about two countries, so you can't have both models being having the lowest opportunity cost in the production of their clothing. No. Okay, so C, country X has a comparative advantage in wheat. Okay, so we can see that they can produce at 1 to 1/2. Okay, whereas here we're looking at 1 to 20. So yes, that first part is true. And an absolute advantage in clothing. Well, that's just not true. Country X does not have an absolute advantage. Country Y has both an absolute and comparative advantage in clothing. Yep, it does. And yes, it does. Okay, so the answer would be D. Country X joins an existing customs union comprising Y and W, which has a common external tariff equal to X's initial tariff. After joining the customs union, X imports cars from Y that it previously imported from V. Okay, so we've got a number of countries here. You'll see these again and again as you work through these multiple choice tests. Okay, so right, and then we've got X. Now I've drawn rings around these countries just to indicate that they have common external tariffs. Okay, so we can see that X now joins this customs union. Okay, so after joining the customs union, X imports cars from Y that it previously imported from country V. This is interesting because previously they could have imported cars from Y and had that external tariff imposed on them, but they chose to do so from V, probably because the price of those cars was actually lower from V. So in terms of the most productive, the cheapest producer, then we can see that it's likely to be V. This seems to be an example of trade diversion where a customs union an external tariff means that actually you start trading with a less efficient trading partner because you can do so under free trade. So therefore, in terms of the costs of production, they are likely to be higher. Okay, we are likely to see a higher cost of production. So actually, if you can identify that, you already know the answer now, because the other options are not similar to that. Further to this, what's also interesting though is just to understand that the price is now going to be lower because there's no tariff. Okay, there's none of this sort of force field element because X is now in here. Okay, so yeah, those two are true. Okay, 29 diagram shows the supply and demand of the pound sterling on the foreign exchange market. What should the UK monetary authorities do to achieve an exchange rate of US dollars $2.50 equals £1? Okay, right, so we can see that that's our current equilibrium at just $2 where 25 billion is consumed, but we can also see at $2.50 20 is demanded. Okay, so that's the actual quantity of supply and demand at this higher rate. Okay, so to increase demand, sorry, let's use a ruler, that's sloppy. Let's just input that new demand curve. There it is. We can see that we've actually got a shift there which is equivalent to 10 billion euros, sorry, 10 billion pounds. Okay, so therefore the answer would be buy 10 billion of sterling. Okay, right, final question, nice easy one to finish off. An economy is currently in equilibrium at point X. Okay, a cut in direct taxes increases disposable income, so we're now at point B, and has a positive effect on the incentive to work. We're now at point C. Okay, so that's going to be our answer, point C. Okay, so there we go, that's 2010's paper. Thanks guys.